$3 trillion. That is what the Federal Reserve printed in roughly 2 years to keep markets alive during the pandemic. So here is the obvious question. If the dollar is heading toward collapse, why can't the same institution that prints it just stop it? The answer is not what most people expect. The Fed has two main tools. It sets interest rates, which controls how expensive it is to borrow money, and it buys or sells government bonds, which pulls cash in or pushes it out of the economy. For decades, those two tools were enough. They are not enough anymore. To understand why, you have to go back to where the dollar's power actually came from. In 1944, 44 countries met in Bretton Woods, New Hampshire, and agreed that the dollar would be the world's reserve currency. Every other currency would be pegged to the dollar. The dollar itself would be backed by gold at $35 per ounce. The logic was simple. America held 2/3 of the world's gold reserves after World War II. It made sense to anchor everything to that. Then in 1971, Nixon broke the gold link entirely. The dollar became what economists call a fiat currency, meaning it is backed by nothing except the full faith and credit of the US government. Most economists at the time predicted this would destroy confidence in the dollar. It did the opposite. Countries still needed dollars because they needed oil. In 1974, the US struck a deal with Saudi Arabia. OPEC would price oil exclusively in dollars, and America would guarantee Saudi security. This created what is called the petrodollar system. If you are a country that needs to buy oil, you need dollars. To get dollars, you either export goods to America or borrow them. Either way, demand for dollars stays structurally high, regardless of how many the Fed prints. This gave America something no other country has ever had. Economists call it the exorbitant privilege. The US can run a trade deficit, meaning it imports more than it exports, and the rest of the world essentially finances that deficit by accepting dollars in return. America prints dollars. Other countries hold those dollars as reserves and buy US Treasury bonds with them. The dollars flow back to Washington as loans. The cycle repeats. That cycle is now breaking, and it is breaking in 3 separate places at once. The first break started in 2022. When Russia invaded Ukraine, the US and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. From Washington's perspective, this was a reasonable response to a war. From the perspective of every other central bank on Earth, it was a warning. If the US can freeze Russia's dollar reserves, it can freeze anyone's dollar reserves. The dollar stopped being just a currency. It became a weapon. Within months, countries that had no particular quarrel with America started asking the same question quietly. How much of our national wealth do we really want, held in an asset that can be switched off by one government's decision? China began settling more oil trades in yuan. India started buying Russian oil with rupees. Brazil and Argentina explored local currency arrangements. Saudi Arabia, the country whose petrodollar deal had anchored dollar dominance for 50 years, began discussing pricing some oil sales in yuan. None of this destroyed the dollar overnight. But the direction changed. Reserve managers at central banks around the world, the people whose actual job it is to hold the safest possible assets, started diversifying away from US treasuries in a way that had not happened since before Bretton Woods. The second break is the US debt itself. The national debt crossed $34 trillion in early 2024. Interest payments on that debt are now running at over $1 trillion per year. To put that in context, the US spends more on interest payments than on defense. When the Fed raised interest rates to fight inflation between 2022 and 2024, it solved one problem and created another. Higher rates mean existing debt becomes more expensive to service. The US government has to issue new bonds at higher interest rates to pay off old bonds that are maturing. This is a refinancing spiral, and it is happening at a scale that has no precedent in American history. Here is where the Fed's problem becomes structural rather than cyclical. If the Fed cuts interest rates to ease the debt burden, it risks reigniting inflation. If it keeps rates high to control inflation, it accelerates the debt spiral. There is no policy setting that solves both problems simultaneously. The Fed is not facing a difficult choice. It is facing two outcomes that are both bad, and it has to pick one. The third break is the loss of the inflation-absorbing mechanism. When America printed money in the past, much of that money flowed out of the country. Other nations needed dollars, so they absorbed the excess supply. The inflation that should have hit American consumers got spread across global markets instead. This is why the US could run large deficits for decades without the kind of inflation that destroyed currencies in Argentina or Turkey. That absorption mechanism is weakening. because fewer countries want to accumulate dollar reserves the way they used to. If dollars printed by the Fed stay inside the US economy instead of flowing abroad, they drive up domestic prices directly. The Fed then has to raise rates to suppress that inflation, which increases the cost of servicing the debt, which forces the Treasury to issue more bonds, which the Fed may eventually have to buy itself, which is just another word for printing more money. This loop has a name in economics. It is called fiscal dominance. It is the point at which a government's debt becomes so large that the central bank can no longer conduct independent monetary policy. It has to prioritize keeping the government solvent over keeping inflation low. When that happens, the central bank loses the credibility that makes its currency worth holding. The Fed has not reached that point yet, but the trajectory is visible. Now, here is the part that most dollar collapse arguments get wrong. A collapse does not mean the dollar goes to zero. It does not mean America becomes Zimbabwe. What it means in practice is a sustained decline in the dollar's purchasing power relative to real assets, and a decline in its share of global reserves. The dollar's share of global reserves has already fallen from roughly 73% in 2001 to around 58% today. That is a slow collapse, not a sudden one. But slow collapses are still collapses. The Fed cannot stop this for a reason that has nothing to do with its technical tools and everything to do with political reality. Reversing the dollar's decline would require the US to run budget surpluses, meaning the government spends less than it collects in taxes. No administration in either party has done that consistently since the Clinton years. The political incentives run entirely in the other direction. Deficits buy votes, surpluses lose them. The Fed cannot fix a fiscal problem with monetary tools. What happens when reserve currency status erodes gradually? Other currencies do not replace the dollar cleanly. The euro has structural problems of its own. The yuan is not freely convertible, and China's capital controls make it a difficult reserve asset. The IMF's special drawing rights are too small and too slow-moving to fill the gap. What likely emerges is not a single replacement, but a fragmented system. A world where different regions settle trade in different currencies, where gold plays a larger role in central bank reserves than it has since 1971, and where the US loses the exorbitant privilege without any single country gaining it. For American consumers, that fragmentation means imported goods cost more. The inflation premium that other countries used to absorb comes home. Living standards for people on fixed incomes compress. The government faces harder choices about what to cut, because it can no longer borrow cheaply without limit. The Fed can delay this. It cannot prevent it. The institution was designed to manage a currency that the world wanted. It was not designed to manage the unwinding of a reserve currency system built on 50 years of trust that is now eroding for reasons that a rate decision in Washington cannot address. So, what can actually happen? 3 scenarios are plausible, and none of them require you to believe in a dramatic single-day collapse. In the first scenario, the dollar declines slowly over 10 to 20 years. The US retains significant reserve currency status but loses its dominant position. Inflation runs higher than it did in the 2010s. The standard of living gap between the US and other developed economies narrows. In the second scenario, a debt crisis in the Treasury market forces the Fed to monetize government debt at scale, meaning it buys bonds directly from the government to prevent a funding crisis. This triggers a faster inflation cycle and accelerates reserve diversification globally. In the third scenario, a geopolitical shock, whether a conflict over Taiwan, a Middle East escalation that disrupts oil flows, or a major emerging market country formally exiting the dollar system, acts as a catalyst that compresses years of gradual decline into months. The Fed cannot prevent any of these. It can adjust the timing, it can smooth the edges, but the underlying problem is that the dollar's value rests on trust, and trust is not something a central bank can manufacture with a policy announcement. The dollar has been the world's reserve currency for 80 years. That run may not end this year or next year, but the architecture that sustained it is being dismantled. One bilateral trade deal, one frozen reserve account, and $1 trillion interest payment at a time. The Fed's real problem is not technical. It is that it is the institution responsible for managing a consequence it did not create and cannot reverse.